At noon, and let us now talk about the positives in the economy. And talking about the latest developments, the Fitch has upgraded India's GDP FY26 forecast to 6.9%. Now, the domestic demand, how much will it drive the growth, and at the same time, the consumption boost, the GST rate rationalization? To talk on the impact of all of this, we have with us Indranil Pant, Chief Economist from Yes Bank. Indranil, thank you so much for giving your time to ET Now. It's a pleasure talking to you this afternoon. To start with the data point, the one which Fitch has revised India's FY26 GDP forecast to 6.9%. Now, how realistic do you think this number is given the current tariff scenarios and the challenges which the domestic markets are facing from the global front?
So far as I understood from the document that I just saw, one major assumption that the Fitch is taking is that the 50% tariffs may not be a long-lasting reality. They are, I think, assuming that 25% tariff, which is the penalty tariff, that actually goes away. And therefore, we are in a more manageable situation so far as trade relations with the US is concerned. Plus, they are expecting some talks to actually go through between the US and India, which is likely to be relatively better in terms of the tariff impact that we were talking about on India's growth. Having said that, the GST restructuring is definitely a positive, and therefore they are expecting the consumption demand to be boosted. Plus, they're also expecting the Reserve Bank of India to undertake one more 25 basis points rate cut near to the end of the year. So all that added together, they surely have an upgrade. Now, whether your question of whether we can accept the numbers, I think there are too many moving pieces, and we'll have to watch out how overall things develop. And as I said, there are a lot of assumptions behind this upgrade, how things develop from here on to understand what is the likely implication for India. Talking about our own forecast, we also had initially a 6.5, but the 7.8, which was an upside surprise for us also, led us to actually move our GDP estimate just a tick higher to a 6.6%.
Right, and even Reserve Bank of India in the NIL had a forecast of 6.5%, which was kept intact in the last policy. Do you see there is a scope of revision in the next policy?
I would guess no, because I think there are a lot of, as I said, a lot of moving pieces that are actually clouding the growth scenario at this point in time, and some of that I have already talked about. Now, the emerging worry in my mind, of course, we don't have immediate data on the same, but the emerging worry in my mind is that, yes, the sowing has performed well. It is higher than the last year's period, and most of the sowing for the current Kharif agricultural season is over. Rice sowing is higher by about 6.5%, if I'm not mistaken. But we also have significant damages to crops in areas like Punjab and some parts of West Bengal. So how that factors into the growth projections is also something that we need to take into consideration, and it will be some time before we have an actual analysis in terms of how the agricultural sector, which we had all been putting up at a very robust pace, given the early arrival of the monsoon and precipitations being relatively better in terms of the long period average, whether we have to even mark it down or not. So yes, there are too many moving pieces, and evolving data will lead us to understand how things are moving. Uh, Talking about most of the advanced indicators that we still see rural pushing slightly better than the urban. Of course, the GST cuts to be considered, and that is likely to push urban slightly on the higher side from here on. But having said that, I think for the urban sector, the critical issue is wage growths have been lower, and there have been job losses. And the outlook so far as a future job prospect and wage growth given the uncertainty of the tariff still remains, which might actually sort of hold back consumption to a certain extent from the urban category.
Agreed. Indranil, two quick things. One, Fitch has highlighted domestic demand as a growth driver. Do you see the momentum sustaining even beyond the festive season? And the second one, of course, there can be some negotiations and we are anticipating something on the tariff front, but the tariffs are still going to impact the exports. So do you expect India's growth pivot to rely more on domestic capex and investments?
No, I think first of all, I'm not sure about the private capex yet, and therefore the consumption remains the most important sort of peg for India's growth. And as I said, we were hinging on an expectation of rural growth being relatively better due to the agriculture. So we'll have to understand how the agriculture moves. Yes, there are significant enablers that are now in place to push private consumption expenditure, which includes the income tax cuts that have been enacted in the union budget, which includes the GST restructuring that have undergone recently, and also the rate cuts by the Reserve Bank of India. But when I look at the data, I think the 100 basis points rate cut, yes, on the EBLR side, it has been fully passed through. But if I take the weighted average lending rate, the 100 basis points, the pass through is just about 39 to 40 basis points. On the MCLR loans, it is actually quite low. And therefore, the RBI and the system will have to wait for the pass through to be more complete before we tend to analyze the consumption pattern. Which clearly shows up in the credit growth, which has not yet picked up to the extent that one would actually sort of like. Again, talking about enablers, I think the RBI has provided adequate liquidity to the system. So enablers are all there. Whether it actually translates itself into higher consumption or the additional benefit to the income to the population is to a certain extent saved because of the significant uncertainties is something that we need to watch out for.
All right, all eyes will be there on RBI next now. And Indranil, thank you so much for joining with your views.
Thank you.
With